Now it's time to have a look at your individual psychology. We've looked at the mass psychology, and that is quite easy. That is much easier than the individual psychology. That is much more difficult. So let's delve a little bit into your personal psychology you will experience as a trader. Now, trading appears deceptively easy. Whenever you look at the internet, everybody tells you it's easy as fast, just do this little course, buy this little indicator, and start to make thousands of dollars in a month. That is the biggest lie, and I'm not saying that trading is difficult, but it's definitely not easy, and people make it look deceptively easy. So be aware of what you believe on the internet. It offers the opportunity to make a lot of money fast. Yes, and it's true, but you're gonna need a lot of skill, and it tends to suck you in this idea of making a lot of money fast. And that is all wrong. See it in a different way. It's another skill you're gonna build, like becoming a doctor or an engineer. It's gonna take you time to get the skill and then teach yourself to slowly but surely mature in trading, and then you will be skilled and be able to make a lot of money. But you cannot just jump in doing a 2-hour course and now you're skilled and now you're going to make a ton of money. That's unfortunately also a big lie. Markets attract risk takers. Remember, it loves risk-prone people, or risk-prone people love the markets, but the market will repel the risk-adverse person. The person that doesn't want to take risk mustn't be in the market. You must understand, whenever you're trading in the markets or any form of trading in the markets, it is risk, and you must like risk. If you can't take risk, stay out of the kitchen. Now, good traders are hard-working individuals when they analyze their daily charts or creating strategies, or let's call it non-trading times. They are hard workers. Most of your work goes into preparing, developing strategies, preparing your daily ideas, your trading plan for the day. That is a lot of work. So once you get into the market, when the market's open and you now start to trade, then it's easy. Easy in the sense of not a lot of work. Trading should not be a lot of work. If it's a lot of work, you must get worried about what you are doing. But remember now, a lot of work happens outside market hours. During market hours, it should be easy, because if you prepare your trading plan well, then it becomes easy during the day. You do not fiddle with your strategy during the day. You do not bend the rules during the day. During the day, you just apply what you have decided to do outside of market hours. Remember, when you want to trade, you need to be a realist. You must be a realist. You cannot afford illusions. Get this whole idea out of your head of Porsches and helicopters and private jets and lying on the beach and all those things. All those marketing scams and schemes in the market. Remember, when it sounds too good to be true, it is most likely too good to be true. Telling you that you're going to do this little course, 2-hour course, you can become a professional trader, or I'm going to teach you to scalp in 15 minutes. That is a bunch of nonsense. Understand that you should get rid of every form of illusion or fantasy in your mind when you want to become a trader. Because you're going to have to work hard, learn hard, skill yourself, and then eventually become a successful trader. There is no shortcuts. I can tell you there one thing, there's no shortcut in trading. Nothing beats experience, nothing beats screen time, and you're gonna need a lot of that before you become a successful trader. A successful trader also knows his abilities and his limitations. You must understand yourself. Now, your abilities is what's your knowledge level. What can you do? What can you do mentally? You are capable of certain things once you've got a certain amount of experience, of a certain amount of knowledge, and then applying it on a constant basis. So you must understand your abilities before you attempt the markets. And then your limitations also. Know yourself. What is your emotional limitation? What is your limitations on time? What is your financial limitations? You can't come into the market with $100 and think you're going to make $10,000 a month. You cannot come into the market with a $200 account and then trade the DAX, for argument's sake, because it's way too small. So understand your financial limitations and then work around that. Understand your time constraints, because You cannot trade a 15-minute chart or a 1-hour chart if you got a full-time job. Really, it's going to be tough. You must then settle for 4-hour trading and end-of-day trading, for argument's sake. If you travel a lot, you must understand what that will entail and how much pressure that will put on your time. So you must understand that you must know how much money you've got to trade, how much time you've got to trade, and your skill level. Your skill level comes from not only just doing a course and then think you've got the skill level. No, 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 no. It is from experience after you have skilled yourself. So please understand that. A trader cannot just come into the market without understanding his own abilities and limitations. You never cut corners and make realistic plans. Be realistic in your plans. Be realistic in your planning. Don't think I'm gonna, as I've said, take $100 and make $10,000 a month. No, you're gonna make a few percent a month if you are good at it. These people telling you that they've got $100 and now they've made $5,000. I can promise you there's a scheme, a scam, and a lie behind that. Don't get caught by that. The goal of any good trader is not to make money. It is to trade well. Now you're going to say, Johan, but I'm here to make money. Yes, we all trade to make money. But you cannot think about money every day, every move. Look at the dollar profits and losses. You must understand, remember now I showed you the video on what is a positive expectancy. You cannot sit there with every single trade that you are in and watch the dollar amounts going up and down. And I need so much to make a living. No, the market couldn't care less what you need and what you want from the market. You must trade well. What does trade well mean? I end all my videos on my coaching and mentoring and on YouTube. I end all of those videos with trade well. That means following the rules. Following the rules of your well-tested system, which you're going to make a lot of money over time if you think next 1,000 trades. But if you don't think next 1,000 trades, you think this trade, the next trade, you're going to get yourself into a big tangle because you're going to be so focused on the money and not on the positive expectancy. Remember, the positive expectancy is everything. You cannot think about money. So a good trader don't trade for money. It does everything because there's a set of rules for it. Let's think about this. When you get into your car and you drive off to a certain destination, you don't have to sit and think, what am I doing? I should do this and do this. No, you just follow all the rules of the road. You know how to drive a car, you just do things. Every now and then there might happen something, but in general, if you keep doing the correct thing behind the steering wheel, you will arrive at your destination unharmed. And the same with trading. If you just sit there, trade by trade by trade, just follow your rules and your system, hitting stops when you need to hit stops, hitting targets when you need to hit targets, you will eventually make money. Money will then, if you trade correctly, come as an afterthought. It sounds funny, but money cannot be in the forefront of your head when you trade. You must have your rules and your systems and the trust in the next 1,000 trades. That must be in the forefront of your mind. But if you do everything correct, money will come as an afterthought because the profits will look after itself. You look at the money management, the stop losses, the position sizing, following the rules, money will follow automatically. Any good trader will rise to a level where winning doesn't elate him anymore and losing doesn't deflate him anymore. Money no longer influences your emotions. That is when you become a good trader. Where there's a winning trade, you're not over-elated, and when there's a losing trade, you want to sit with your hands in your head, you go, oh man, what? And you get too emotional. The moment you experience those two emotions, you must understand you're most likely trading too big for your limitations, your emotional limitation or your financial limitation. So please be aware of being over-elated or deflated on any form of trade. A winner or a loser, you should stay for it. Yes, it's not nice having a losing trade. There is a little bit of a sadness in it. It's one of those things. We are human. I'm not saying you must be a robot. We are human, and that means that you will experience emotions, but you need to manage those emotions that they don't. Because if you get overexcited or deflated completely, it means you're trading too big. You must then reduce your risk, so that you get more of a neutral stance regarding winners and losers. Remember, a good trader will always cut their losers and allow their winners to run. I know that's very corny and cheesy and all those things, but it's true. Cut your loser when it gets to a stop loss. Do not move those stop losses. Do not say, well, last week it ticked my stop loss and then it's gone up to the target a few days later. So now I'm going to move the stop just a little bit further or take it out of the market. I just want to see what's happening with the next bar or so. No, I can promise you. That time you do that, that market will punish you. It will keep going against you and keep going against you. So cut those losers at the correct place, what you have predetermined before you enter the trade. And let your winners run to targets. Do not allow, a lot of people, especially after they've gone through a little bit of a bad period, of a bad time, where there's a bunch of losers, you might have 10 losing trades in a row or 5 losing trades in a row, or you might have a negative month or two. The urge to take profits before it hits your strategy targets is getting bigger and bigger and bigger because you want to make that money back. You feel like, I want to get that money back I've lost. At least I'm at break even or something like that. It's important. Cut that losers at stop loss because your system tells you to cut that loser when you get to stop loss. Sit to the target, manage your trade, trail your stop losses according to your system because that's what will make you money, by managing your risk and managing your trade. Don't go and give your trade cheaply away. You've worked hard for the entry. You've worked hard with the planning, your trading plan in the morning. You've done a lot of research and education to get into the trade, and now you want to give it away cheaply just because you're getting emotional? Rather trade smaller and sit your trades to the targets than trading bigger and not being able to sit your trade to targets. That's a very simplistic principle. Don't let your winners turn into losers. What a lot of the times happen is that people, when they go to the target, and this happens usually when the market goes off the bat into the money and it's a big candle in your direction. There's no place of trailing the stop loss yet, but you see it approaches your target and it looks like it's gonna fly. You're gonna think, that one time I took target and then the market went 3 times further. This time I'm gonna move the target. You take out the market, I'm just gonna see what it does. Just to see it hits the target level, it reverses and then comes back all the way to entry, and you sit there, you cannot pull the trigger, you cannot. And then it goes back to a stop loss and you take a full loss of risking maybe 1%, and you would have gained 1 or 2 or 3% on that target. Guys, that is soul destroying for your emotions. You cannot do that. Please never ever do that. Your system tells you, yes, my stop, there's my target, stick with your target, take the trade because that's your trading plan. That's what you've tested your system for. That's why you entered into the trade, not to go and fiddle with the targets. That's something I seldom or actually never will do. I might once a year do something based on news or based on some new stuff coming in after my entry. But I can tell you 99.9% I will stick to my target ruthlessly because I'm going to protect my position with everything inside of me. I'm not going to give it away cheaply. So if you're not following your trading plan, it just means you don't know where you are going. So you're going to end up where you don't want to be because you're going to be out of strategy. You're going to be out of logic of the trade. So don't do stuff that you didn't plan for doing. The saying goes, if you do not know where you are going, you will wind up somewhere you never wanted to be. So your trading plan is everything. And never self-sabotage yourself. There's a lot of things you can do, but I want to focus on one specific one, and that's what we call blaming. Blaming others, blaming the markets, blaming your broker, blaming your account size, blaming. Remember, you are responsible for your own trade. You think next 1,000 trades, a single trade should never be an issue. If you position size correctly, it should never be an issue. But now you start to blaming the circumstances, you're blaming your account size, you're blaming other people, you're blaming the markets, you're blaming the broker. Stop blaming. Take the blame yourself because it's your responsibility as a trader. Learn from the past. really learn from your past experiences. What is insanity? It is doing the same thing again and again and again, but expecting different results. That is insane. So learn from your past. Look for repetitive patterns of certain stupid things or certain behaviors. Don't lose money because you're consistently doing something stupid on your emotions, or you do a specific thing when you take a trade. Write it down, learn from your past, and don't keep repeating it. Okay, that is just gonna be soul destroying, and you will never become successful. That you must get victory over those stupid things by making a diary, writing it down, that you can recognize these things and don't repeat it unnecessarily. You must try it as objective as possible. Leave your opinions, your thoughts. Every time I say I think, that's when usually I lose money. You don't want to think, you don't want to have your own opinions about the market. You know what? The market couldn't care what you think. The market couldn't care what your opinion is about the market. If your opinion is bullish on this and the market keeps falling, your opinion means nothing. So you've got a system, a trade plan, and that trade plan doesn't include your opinion or any thinking. It just includes when A, then B, when B, then C, if not D, then C. It must be clear cut. So keeping a journal is very important because you need to work equally hard on yourself than you're going to work on your strategy. Too many people study for years and years and years strategies, this indicator, this market commentator, I saw this news, and they can tell you everything about all the indicators in the market, about so many strategies, but they know nothing about themselves. When they sit and trade, they become emotional. They keep on repeating stupid things. They've got this things they keep on doing that keeps them poor, that keeps them losing money, but they keep doing it, and they rather work on another strategy, attending another course, buying another indicator, than working on their own emotions, just sticking to the rules, trading well. That's all that you need to do to become successful. You don't need another book, you don't need another course, you don't need another nothing. The only book you need and another course you need is about your emotions, your individual psychology, learning, and the only book you actually need is your diary. Writing down whatever you've got to trade, write down everything you've experienced, write down your emotions, anything you've done wrong, stuff you've done right, and then learn from that. Remember, we plan our trades and then we trade our plan. That's cheesy, I know. The market is full of that, but it's true. You're going to plan every single trade. You're going to do your trading plan each morning based on your larger trading plan, what you're going to do for today, and then you're going to follow that plan and those rules to the T for the whole day. So plan the trade outside of market hours. During market hours, you just trade your plan. Be honest to yourself. Don't lie in your diary, guys. Just don't lie. Just be honest to yourself. If you're stuffing up, you can lie to the world. You can lie to anybody except yourself. So don't lie to yourself. Be honest. Never take a loss greater than your predetermined risk. Whenever you entered into a trade, you've decided to risk, say, $20 or $100 or whatever the dollar amount is. Never take a bigger one by moving that stop loss. Never ever move that stop loss. Never ever move that stop loss. It's like going into a casino and say, I'm going to put a $5 or R5 piece into the machine, in the slot machine. And you know now, that's what you can lose. It's not going to jump out of the machine and grab out of your wallet some more money. No, what you put in, that's what you're willing to lose. So make sure that you never lose more than you intended by doing something stupid. Emotional decisions, guys, like moving your stop loss, is lethal in the market. Going anyway outside of your strategy, outside of your trading plan, is an emotional decision 100% of the time, and it's going to destroy you. It's going to absolutely destroy you. Never revenge trade. If you lost money, never say to yourself, I need to make this money back. No, you don't need to make it back. You need to think next 1,000 trades. You need to think, well, this system will make me money eventually. Never bend those rules to revenge trade. Revenge trade is just, I must make it back. So you double up on your position. You take bigger positions. You just want to make this money back. Usually revenge trade comes after something stupid. You've added to a losing trade. You started out well and then you thought, okay, I can buy some more because it's now halfway to the stop loss. If I started with $100 risk, if I take another $100 risk, just think how much can I make when it flies up the page. And then it goes right through to stop loss. You say by $200 loss, I can't. You pull a stop loss again, it turns into $1,000, $2,000 loss, which is detrimental. And then you want a revenge trade. Now I must make the money back. Now you sit there right through the day, right through the night, scalping the market for 3, 4, 5, 6 pips because you want to make back this money you've lost. No, just don't start with something stupid. You won't need revenge trading. And if you've done everything right, still, if you've taken a couple of losses, don't revenge trade. As simple as that. You do not have to trade often, guys. You just need to trade well, that's all. You just need to select 1 or 2 excellent trades in a day. That is enough for you to earn a good income. So when you develop your method, when you develop that method, make sure that your rules are clear. When A, then B. When B, then C. If not D, then C. And if you're outside of any of those rules, you don't know what to do next, exit the trade. That's my personal rule. For your sound psychological state of mind, make sure that you cover every rule that can go wrong. Okay, and if none of the rules apply anymore, have another rule, exit the trade. Develop a system for every market type. Remember now, you would see a trending market or a sideways market or a consolidation market. You must have strategies that allow you to trade all 3 of those. Because otherwise, you're going to constantly have a mindset of, for argument's sake, trending strategies. No, they are the best, they are fantastic, but the market only trends maybe 40% of the time or 30% of the time. What about the other times? So for your psychological well-being, you must know that you've got a strategy that will cover trending markets, it will cover sideways markets, range-bound markets, and it will also help you with consolidations where the market just consolidates into nothing. Even worse than a normal trading sideways range market. So you need to have strategies that will give you peace of mind to remember that doesn't matter what happens in the market, doesn't matter what phase will come in, one of my strategies or 2 of my strategies will work, and most likely the other strategies won't come into play because you have designed it that way. But remember, there are 3 phases in the market mainly, and you need to be able to trade all 3, and for that you're going to need at least 3 different strategies. The sideways market, the trading range bound market strategy will most likely fail in a trending market. Okay, and vice versa. So you'll always have a strategy that will fail. You will always have a strategy that's doing well and something that does nothing or mediocre. So you must understand that. You don't sit here during a trending market and every now and then your range bound strategy will give you an entry. And then it fails, and 2 months later, oh no, that's a bad strategy. Let's scrap that. I'm going to stick with trending. No, you can't, because the market goes through phases. For your sound psychological wellness, have 3 strategies or 6, but in any case, you need a minimum 3, but at least 1 for every phase. You must have something that you can get entries. Make sure that you cover a lot of different entries, possible entries. Because you don't want to sit in a scenario where the market somewhere is running and you've got no position. So different types of entries, different types of strategies is very important to get you into the market some way or other, but based on a clear set of rules. Remember now, under all circumstances, you must know what to do next. You can never be out of a plan, never ever. So when you develop or plan your financial well-being in the markets, when you do this money management plan, remember, first thing you must keep in mind is long-term survival. Then the second thing is steady growth. And then you can think about high profits. Most people come to the market, I want high profits. I might think about steady growth one day. Long-term survival, who cares? No, it's wrong. Your first aim must be long-term survival. Then you must really focus on steady growth, slowly but surely. And then only once you've got those two under the belt, you can look at high profits. Just remember one thing. Always remember this, that you are the weakest link in your trading system. Your trading system has been tested. It's been proven for over 20 years or 10 years, or how long did you back test that? And now you're trading it. You are now the weakest link, because you are the only one that can screw around with the rules, or do stupid things, or walk in with your opinions, or changing your mind during a trade. So always remember, you are the weakest link. Decide that you are in this for the long haul. Don't come to me and say, Johan, I want to try trading for a few months, for 3 months or 6 months. Rather pack your bags and go. I'm not going to try to become a doctor for 6 months. I'm not going to try to become an engineer for 6 months. Either you come in, you commit, and you're in it for the long haul, you educate and study and trade and get enough experience so that you can do it well, or don't even think about it. It's not something you are not serious about. You don't have to sit and trade the whole day. You can trade on end of day charts. You can trade just two times a month, as long as your strategy tells you that and you're serious about it. The analysis is easy. I know it's easy. Anybody can analyze the markets and have a big talk about it. We talked about the sheep in the previous videos. We talk a lot, but to execute the method, that's very few people can do that. That's where the successful traders come, when they are able to execute their method. They got the plan, they did the analysis, and now a lot of people can't execute the method. But keeping to your method, keeping the next 1,000 trades in mind, that should make it much, much easier. How's the saying going? It is the things that few people can do that makes you money. As simple as that. That will make you successful, because if everybody was able to execute and follow their method 100%, well, everybody will be traders and everybody will be very rich. Always think that next 1,000 trades. Guys, that's the biggest secret, if there's a secret in the market, is to think next 1,000 trades for your positive expectancy. The best traders are simply not afraid, because they've got this consistent vision of the future. They got this vision of the next 1,000 trades. They know that this one single trade is just 1 out of 1,000, and they know if this one fails, there will be another one, and there will be another one. So they're simply not afraid. First, accept the risk before you enter the trade. What does that mean? If you go to a slot machine, I like to use the gambling as an example, it's an easy example, but if you go to a slot machine, you just take your $5 coin. I don't know, I'm from South Africa, I don't know if your dollars are coins or what's notes, I've got no clue, I'm not a gambler. But if you take a $5 coin and you put it into the machine, that is accepting the risk. I haven't seen, when I walk past those slot machines, someone that gets emotional. They actually sit there in the old years like zombies. Boom, boom, next one, and the arms just go like that. I know now they push buttons, they do all kind of things. But those here were the slot machines. None of them would put in $5 coin and then they pull the lever and they come up and say, oh no, they're all crazy and emotional about it. No, they just take another $5, put it in, pull the lever. They know they've got the odds at a certain time for them. So they need to do a certain amount of these $5 coins. And eventually they might get a jackpot or not. And that's what trading is all about. You keep on putting these 1% into the market until you catch a few good ones. So accept the risk before you take the trade. So you write off the money in your head before you enter the trade. Write off the money in your head before you enter the trade. Ripping it up. See it in your mind. Okay, I'm putting $100 in, see $100 go, whoop, and you just see. Now you've got no expectancy of getting it back. If the machine pays out, meaning the market pays out, great stuff. If it doesn't, you already wrote off the money. Remember, the first loss is the best loss. That means don't do anything stupid that you lose more than what you wanted to put into this machine. Remember, there is the risk of losing money, and then there's the risk of losing a lot of money. You decide.